of statements, just a recap of those statements. That in case of, for example, I'm just reminding us of what we said. We say that when you look at water pumps, and generator, we basically say that under manufacturing, we basically grant them investment allowance at the rate of 50% in the first year, 25% on a straight line per annum. That is from the second year on the remaining balance. From the second year on the remaining balance. And lastly, we were saying that in case of, let's say, for example, in case of hire purchase, let's say you buy an asset, you buy what you call an asset on what you call hire purchase. If you buy an asset on hire purchase, the value that basically qualifies, we say that the value that basically qualifies, if you buy an asset on hire purchase, the value that qualifies for investment allowance is what's called the cash price. Cash price is what qualifies. We say qualifies for what you call for investment allowance. Cash price is what qualifies for investment allowance. We say ignore what you call the hire purchase. So what qualifies for investment allowance? It is the cash price. And we do what? We ignore what you call the hire purchase. It is the cash price that qualifies for investment allowance. We ignore what you call the hire purchase. Together, team. What qualifies for investment allowance in case of hire purchase? It is the cash price. So if an examiner brings a question and gives you the hire purchase and the cash price for a fixed asset, the value that definitely qualifies for what you call the investment allowance, we say is the cash price. Cash price is what qualifies for what you call investment allowance. Perfect. So then how do you get investment allowance? We say that investment allowance is equals to investment allowance or wear and tear. In case of wear and tear, we say that wear and tear rate, wear and tear rate, then you say times wear and tear rate into brackets, because initial value, we are not using written down value because nowadays they're basically on a straight line. Initial value, then you say plus additions minus what you call the disposals together. This is how we basically calculate what we call the investment allowance for wear and tear. So the wear and tear rate either is 25 or 10% times into bracket. We say the initial value plus what we call additions. These are assets that have been bought during the year. Then you less assets that have been basically disposed during the year together. Then you less the assets that have been disposed during the year. You give me a yes if you're together. You give me a yes if you're together. Perfect. Then you say the following values. You say the following values we say are used. We say the following values are basically used as addition. We say during what we call the year. So the following values, we use them as addition during the year. The following values, we use them as addition during the year. One, we say, if you buy an asset, we say the purchase cost plus cost incurred, we say before the machine is put to use, plus the cost that is basically incurred before the machine is put to use. We say that the costs that are basically incurred before the machine is put to use, we have installation, i.e., we call it installation cost, installation. We have the taxes, what we call the taxes paid. We have the taxes paid, e.g., we have VAT and what we call the custom duties, etc. VAT and the custom duties, etc. We also have the transportation cost and executives. We also have the transportation cost and etc. So if you purchase an asset, that will be during the year, that will be the value of addition plus the costs that are incurred before the machine is put to use. I have talked about installation, taxes paid, like VAT and the custom duty, but you also have the transportation cost together. We also have the transportation cost together. We respond with a yes, if that is at all. We give it a yes, if that is at all. So then we say the second scenario, say in case of a trade-in, what we call a trade-in situation, in case of what we call a trade-in situation, in case of what we call a trade-in situation, in case of a trade-in situation, the value of the new asset, we say that the value of what we call the new asset. So the value of the new asset, we say that the value of the new asset, brought in, we say qualify as addition. So in case of a trade-in, we basically say that the value of the new asset that is brought in qualifies to be what we call addition, qualifies to be addition together. The value of the new asset that is brought in, that is what is going to qualify as an addition. You give me a yes if you're together. Perfect. Then we say in case of hire purchase, in case, we just put in case of what we call hire purchase, in case of what we call the hire purchase, in case of the hire purchase transaction, in case of what we call the hire purchase transaction, in case of the hire purchase transaction, we say cash price, we say is used and we ignore what we call the hire purchase, and we basically ignore what we call the hire purchase. That in case of hire purchase, cash price is used, and we ignore the hire purchase. Then we lastly, as an NB, that is an addition, we say that for SUV and what we call saloon car, for SUVs and what we call the saloon car, for SUVs and what we call the saloon car, SUV, if the value, we say exceeds 3 million, if the value basically exceeds 3 million, we restrict, we say to 3 million. So when you buy an asset, and that is the addition. In case of SUV, those are sport utility vehicle, Mercedes-Benz, Land Cruiser, and saloon car. We're basically saying that if the value exceeds 3 million, we restrict to 3 million. We respond with a yes. We restrict to 3 million. Give me a yes if you're together. We basically restrict to 3 million. Perfect. So then the last part is on the disposal part. The last So part is for disposal, we say the following qualifies, we say to be what we call the disposal, qualifies to be disposal value. That for disposal, the following qualifies to be disposal value. Number one, that will qualify to be disposal value, we call it sales proceed. We call it sales proceed of an asset. So the value that you get when you sell an asset altogether, the value that you get when you sell an asset, that will qualify as the disposal value. Together, team, that in case of disposal, the sales proceed, the value that the asset has been sold, qualifies to be the disposal value together. In case the sales proceed of an item. The number two, we say for an item stolen, for an item stolen, for an item that is stolen, or we say involved in an accident, for an item that is basically stolen or involved in an accident, we say insurance, we say that insurance compensation, we say qualifies to be what it qualifies to be the disposal value. Make sure those concepts are at the back of your mind. Let's say, for example, you had an asset, and you're saying that, for example, for an asset that is stolen or involved in an accident, the disposal value will be what you call the compensation. The insurance compensation qualifies to be the disposal value. For an asset that is stolen or was involved in an accident, the value that is compensated by the insurance company is what qualifies to be the disposal value. You give me a yes if we are together. That value qualifies to be what we call the disposal value. Perfect. Thank you so much. Then the last item before we get to the question. For saloon cars, then say for saloon cars and what we call the SUVs, for saloon cars and SUV, for saloon cars and SUV, if the value, we say, was restricted, if the value was basically restricted, if the value was restricted, if the value was restricted, when added, let's say, when added, we say disposal value, we say is determined as follows. So if you're disposing an asset that was basically restricted, an asset that was restricted during addition, are we together? So the disposal value should also be restricted. I am saying that when you're adding an asset, the asset was restricted. It therefore goes that when you're disposing, the asset should also be restricted. So how do we get the disposal value in that case? So we say that the disposal value, i.e., we say disposal value, the disposal value should be what we call the sales proceed, sales proceed, sales proceed, that is just the SP, sales proceed. The disposal value should be the sales proceed over what you call the initial cost. Then you say times restricted value, which is 3 million. Are we together here, team? I want us to understand this. That if basically, we are saying that if basically you are disposing an asset that was restricted when you are adding it together. Therefore, it goes that when you're disposing also that asset, you need to restrict. How do we restrict? We say the sales proceed over what we call the initial cost, that is the buying price, then you multiply by 3 million. This will not qualify as what? As the disposal value, but you restrict. What you get is what you get as the disposal value, Tubonyeza yes, kama tuko sawa. Tubonyeza yes, kama tuko sawa. If you're together, we respond with yes. If we are together, we respond with yes. Perfect. Then I only have to make one statement. In case of trade-in, in case of what we call the trade-in, the disposal value, when you're talking about trade-in, in case of trade-in, the value of the old asset is deducted as the disposal value. You're saying that in case of trade-in, we say that in case of trade-in, we say that in case of trade-in, we say in case of a trade-in, lastly, we say in case of what we call of trade-in, the value of what we call of the old, the value of the old asset, we say qualifies as what we call as the disposal value. The value of the old asset qualifies as what we call the disposal value. So that is that. I want us now to go to the practical work. Is there any question before I get to the practical work? Kuna mtu ana swali? Is there a question? Kuna mtu ana swali? Can I proceed to the questions? Can I proceed to the questions? Can I proceed to the question? Is there any question regarding, we move on? Perfect. So I want the first question. I want us to start on the first question. I want us to pick on December 2024. December 2024. I want us to pick on December 2024. December 2024. That is question 4C. December 2024. We start with the first question, DEC 2024. Question 4C. DEC 2024. Question 4C. Are we on it? Let's start with that question. DEC 2024, question 4C. DEC 2024, question 4C. If you're there, you respond with a yes. DEC 2024. So perfect. So I want us to read that question. So we're being told, Adam Mwema, the examiner tells us that Adam Mwema, a retired engineer, Adam Mwema, a retired engineer, sets up a manufacturing factory in industrial area on 1st January 2023 to fabricate, Mechanical and automotive parts at a cost of 44,900,000. At a cost of 44,900,000. So then the examiner tells us the operation commenced on 1st January, that is 2023, except for commercial building, which was put into use from 1st September, except for the commercial building, which was put into use on 1st September. So then you're given the breakdown for the manufacturing. So the breakdown of 44,900,000. Number one, you're being told that the factory building, that is 18 million. Which investment allowance does it qualify for? Factory building. Factory building, it qualifies at which rate? Which investment allowance and at what rate? Factory building, which investment allowance and at what rate? Which investment allowance and at what rate? Factory building. Which investment allowance does it qualify? At 50%, we call it ID, but you say at 50% in the first year, then you say 25% on the straight line, 25% on the straight line. That is from the second year on the remaining balance. Number two, we call it office within factory building. Office within the factory building. How would you treat that? Office within the factory building. 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 What does it qualify? At what rate? That's a commercial property. So it qualifies for investment allowance at the rate of? At what rate does it qualify for investment allowance? At the rate of? We say at the rate of 10% on a straight line. You mark them. If you have a physical paper, you mark it then. Then the next we have what's called second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. Second-hand imported machinery. So what does it qualify for? The second-hand imported machinery. For the second-hand imported machinery, it qualifies for which investment allowance? Second-hand, remember this is manufacturing. The second-hand imported machinery qualifies for ID. We understand at the rate of 50%, that is in the first year, then 25% on a straight line per annum, that is from the second year on the remaining balance. Then you have the next, what you call land. Land, does land qualify for investment? And which investment allowance does the land qualify for? Does land qualify for investment allowance? Land, does land qualify for investment allowance? Does land qualify for investment? No. Land does not qualify for any investment allowance. So that we are not going to use. The next we have what we call engineer fee for machine installation. What we call the engineer's fee for machine installation. Engineer's fee for machine installation. Engineer's fee, that is ID, at the rate of 50% in the first year, 25% per annum on the straight line, that is from the second year on the remaining balance. The next is what's called the parking bay. Parking bay. Parking bay. Parking bay. What does the parking bay basically qualify? Parking bay. That is also investment allowance at the rate of 50% ID, at the rate of 50% in the first year, 25% per annum on the straight line. That is from the second year on the remaining balance. Then the next we have what we call conveyor belt. Conveyor belt, Matsura. Conveyor belt, Matsura. Brand conveyor belt, what does it qualify for? Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. Conveyor belt. So which investment allowance? Japan. That is at the rate of 50% in the first year, at the rate of 50% in the first year, and 25% per annum on the straight line. That is from second year on the remaining balance. Then lastly, we have commercial building, and the figure is 10 million. Commercial building, what does it qualify for? Commercial buildings, commercial buildings, 10%, 10%. Thank you so much. So I proceed to the additional information. Alan, Ida, thank you so much. I proceed to the additional information. On the additional information, we've been told that commercial building, we are given a breakdown. Commercial building include what we call a showroom. So the figure of 10 million, we can put it as probably working commercial building, commercial. We have it as a commercial building. The figure is 10 million. So 10 million, this one includes what we call showroom. So we have the showroom. We have what we call the showroom. And the showroom and retail. Showroom is 2.8. Then we have what we call retail shop. What we call the retail shop. So retail shop is a figure of 3.2. So what is the figure for the commercial building? What is the figure for the commercial building? What is the figure for the commercial building? So what is the figure for the commercial building? If you less that, what is the figure for the commercial building? So when you less that, what is the figure for the commercial building? Because this figure is inclusive of a showroom and retail shop. So what is the difference? Is the difference 4 million? Is the difference 4 million? Perfect. Showroom and retail shop, they qualify for investment allowance at what rate? Showroom and the retail shop, they qualify for investment allowance at what rate? Showroom, they qualify at 10%. At 10%. So that is analyzed. So then you're being told that factory building include a warehouse. So there's a working two. We have the factory building. What is the figure for the factory building? What is the value for the factory building? What is the value for the factory building? What is the value for the factory building? What is the total value for the factory building? So that was a figure of 18. We had it as 18 million. But we've been told that on this building, on this factory building, there's what we call, there's a warehouse. So we need to less that warehouse. We need to less that warehouse. And the figure is 2.2. The figure is basically 2.2. So what is the factory building? The figure for the factory building. What is the figure for the factory building? The figure for the factory building. Give me the figure for the factory building. Provide me the figure for the factory building. Provide me the figure for the factory building. The figure for the factory building. Provide me with the figure. So this is 15,800,000. Aida tuko sawa? Aida, are we together? Perfect. Abia. Editor, up, we're together. So this warehouse, what will it qualify for? If we less it, warehouse will qualify for? The warehouse will qualify for investment allowance, that is IBD. We understand at 10%, at 10%. IBD at the rate of 10%, at the rate of 10%. IBD at the rate of 10%. So we proceed to the next. The examiner tells us that additional information number 3, a building that had been constructed, a building that had been constructed, a building that had been constructed at a cost of 12 million was leased to Juhudi Manufacturers Limited. A building that had been constructed for a figure of 12 million was leased to Juhudi Manufacturers Limited for 5 years. So being told that annual lease rental was agreed at 2.2. Adamil Mwema imported the machinery from China at a cost of 5.2 and installed it in the building and started operation. Do we grant investment allowance for the building that you've leased? Do we grant investment allowance for the building that you basically leased? Do we grant investment allowance for a building that you have leased? Do we grant investment allowance for a building that you basically leased? Either. Do we grant investment allowance for a building that you basically leased? No, we don't grant. That's why if you have options, in order for you to qualify for investment allowance, you buy instead of leasing altogether. If you want to qualify for investment allowance, you buy instead of leasing. Are we together? If you lease, you're only going to be entitled to what we call the lease rental, rentals as allowable expense. But if you have the option to lease or buy in order to qualify for what you call investment allowance, in order to qualify for the investment allowance, in order to qualify for the investment allowance. However, what about the imported machinery of a figure 5.2? Is it going to qualify for investment allowance? The imported machinery for 5.2, is it going to qualify for the investment allowance? Is it going to qualify for the investment? Yes, that imported machinery is going to qualify for the investment allowance. Yes, that is going to qualify for the investment allowance. So that is sorted. All of us, are we together? All of us, are we together? Perfect. So then I proceed to additional information number 4. So the examiner tells us to improve the performance of the factory. We are being told that to improve the performance of the factory, Adamil Mwema computerized operation at a total cost of 15 million. Adamil Mwema computerized the operation at a cost of 15 million, out of which 30% was software related. So out of which, so we have computers, and then we have the softwares. We have what's called the software. So the figure is 15 million. But the examiner tells us that basically 70% was the computer. So 70% times 75% times a figure of 15 million. So what is 70% times a figure of 15 million? Because that's what 70%, then 30% was in relation to software. 30% was basically in relation to the softwares. 30% was basically in relation to the software. Just a minute. Give me a few minutes. Sorry for the interruption. So then 70% is basically in relation to the computers. So what is 70% of 15 million? Give me 70% of 15 million. 70% of what I call 15 million. So that should be 10, 500. What I call the 500. We have it as 500. What about the 30%? that is in relation to the software. 30% that is in relation, that should be 45. That should basically be 45. So computer software and computers, they qualify for investment allowance. Number one, computer and computer software, those are wear and tear. At what rate? Those are basically wear and tear at what rate? Wear and tear at what rate? At the rate of 25%. At the rate of 25%. Training at the rate of 25%, not 10%. Training that should be wear and tear at the rate of 25%. So then the examiner tells us on additional information number 5, that the following assets were also purchased. The following assets were also purchased. We say on 1st July 2023. Number one is furniture and fitting. Number one is furniture and fitting. What does it qualify for? Furniture and fitting. 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 What does furniture and fittings qualify for? Investment allowance at the rate of 10%. Investment allowance at the rate of 10%. At the rate of 10%. What do you call investment allowance at the rate of 10%? At the rate of 10%. The next is a second-hand BMW vehicle. Second-hand BMW vehicle. What does it qualify for? The second-hand BMW vehicle. The second-hand BMW vehicle. The second-hand BMW vehicle. 25. But what do we do to the BMW? There's a concept that we have not remembered. What do you do? The BMW Nini, that's an SUV. So what do? We restrict to 3 million. The amount that is going to qualify for wear and tear should be, that should be 3 million. We restrict to 3 million. Then the next, we're being told that 4-ton lorry, a figure of 1.8. 4-ton lorry, a figure of 1.8. The 4-ton lorry, figure of 1.8. What does it qualify? 4-ton lorry. A 4-ton lorry. Investment allowance at what rate? At the rate of 25%. Thank you, Gauba. Then we have the next, that is what we call the backhoe loader. Backhoe loader. What do you call the backhoe loader? So backhoe loader. What do you call the backhoe loader? Backhoe loader. The backhoe loader. At what rate? That's wear and tear. But at what rate? Wear and tear 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 at what rate? Not 10%. Backhoe loader, that should be 25%. Note it as 25%. As 25%. As 25%. Either that should be 25%. Is that okay? Either that should be 25%. Either is that noted? Either that should be 25%. That should be 25% together. That should be 25%. Matsura, that should be 25%. So then we have the next is mobile crane. Mobile crane. mobile crane. So the mobile cranes, mobile crane, mobile cranes, mobile cranes, mobile cranes, mobile cranes. Galma, why did you say that? Mobile cranes. That's not a trailer, the smaller trailer. Mobile crane. Mobile crane. Galma, you are missing it. Mobile crane. Mobile crane should be 25%. Team, that should be 25%. 25% together. Mobile crane should be 25%. 25% together should be 25%. 25%. Tuko sawa. To give me a yes kindly. Then lastly, we are being told that the factory, the examiner tells us that the factory staff labor quarters were constructed during the year at a cost of $2,250,000 and put to use on 1st October 2023. Factory staff quarters. How do you treat the factory staff quarters? How do we treat the factory's staff quarters? Factory staff quotas, that's IBT, at the rate of 10%, 10%, at the rate of 10%. I know you wonder why I chose on this question. I particularly chose on this question because people did not perform well in this particular question. This is one of the questions that was poorly performed. So before I put it down, we're not going to break before we finish. Before we put it down, please, you see there's wear and tear here, number 5 from 1st July. And we have the labor quota that is for the IBD. We are being told that from what? That is from October. We don't apportion. Please don't apportion. Please don't apportion. Is that okay? Do not apportion. Claim the whole amount. Claim the whole amount. Together. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. Do not apportion. Claim what we call the whole amount. So do not apportion. Claim the whole amount. Is that point at the back of our mind? Pardon, is that point at the back of our mind? Perfect, if that point is basically at the back of our minds. If that point is basically at the back of our mind. So when it comes to investment allowance, I can use 2 methods of doing it. I can separate them, or I can use them as a whole. I've said when it comes to investment allowance, I can basically separate them, or I can do what? I can separate them, or I can carry out investment allowance as a whole, together team. That I can decide to just accumulate the whole amount and carry out the investment allowance. Or I can decide to do them separately. Or I can decide to basically do them separately. Are we together? So the both methods, I will apply them. But for this first question, I will do it separately. For this first question, I will do it separately. We don't prorate. We don't prorate. Don't prorate them. That's why I'm doing this question, Galma. Yes, because majority of the students failed in this question. And the reason why they failed is because they prorate this. So then we don't know that Other meal mwema, we call it the other meal mwema.
As far as this topic is concerned, and the topic is, well, actually the sub-topic is preparation of group accounts, specifically whereby the parent company has invested in an associate, or basically the parent company has invested in a joint venture. So the first thing we need to ask ourselves here is what is an associate, and also what is a joint venture. So maybe you can start by defining what is an associate. What is an associate? And basically in this case, an associate, we say that this is an entity in which the parent company exercises something called the significant influence. So this is an entity, where the parent company, I hope you can also be able to recall that the parent company is called the investor company. The parent company or the investor company exercises something called significant influence. So when we talk about the parent company exercising significant influence, this basically means that the parent company is not in a position to control the operating and financial decisions made by the associate, or even to control its composition of the board of directors, but the parent company is able to influence the operating and financial decisions which will be made by the associate company. Now, a parent company, or basically an investor company, is said to exercise significant influence over the associate if the parent company has acquired shares which lies between 20% to 49%. If, for example, in this case, we are told 𝐎𝐍𝐿imited acquired shares which lies between 20% to 49% of the shares issued by 𝐉𝐻𝐿imited, it basically means that this company here will be able to influence the operating and financial decisions made by 𝐉𝐻𝐿imited. So this company is not able to control the operating and financial decisions of this, but it is purely able to influence. It is able to influence. So therefore, anytime you are given a question and you're told the investor company or the parent company acquired shares which lies between 20% to 49%, it automatically means that the investee company, this company here, is an associate. Is what? An associate. So that is basically the definition of an associate. And then from there we have the other entities here, and basically that is a joint venture. So when we talk about a joint venture, this is an entity in which the parent company and another entity acquire something called a joint control. So this is an entity where the parent company, and another entity acquires joint control. So in this case, when we talk about the parent company and the other entity acquiring a joint control, it basically means that assuming we have two companies, 𝐴𝐿imited and basically 𝐵𝐿imited, so this company may enter into an agreement to acquire equal shareholding or to acquire equal shares in maybe a company which is called 𝐶𝐿imited. So this company acquired 50% of the shares. The remaining 50% of the shares are acquired by 𝐵𝐿imited. So in this case, we say that these two companies have acquired a joint control in C. Joint control means that the operating and financial decisions of this company here, that is C, will be jointly controlled by A and B. So A and B will be jointly controlling the operating and financial decisions which are made by C. And therefore, this company here, we refer to this company as a joint venture. We refer to this particular company as what? As a joint venture. Now, having known what is an associate and basically what is a joint venture, the other thing we need to ask ourselves here, how does the parent company prepare the group account? whereby the parent company has invested in an associate or invested in a joint venture. Now, the preparation of group account in this case is governed by this particular standard, which is International Accounting Standard number 28. And this particular standard requires that whenever the parent company has invested in an associate or basically invested in a joint venture, the group account, the consolidated financial statement should be prepared using the equity method. So the group account in this case, we can say a group account, all the consolidated financial statements should be prepared using the equity method. So equity method basically is a method of accounting, and this particular method, how is it applicable in preparation of the consolidated income statement? How is it applicable in the preparation of the consolidated statement of profit or loss? So first of all, I want us to look on how this method is applicable when it comes to the preparation of the consolidated statement of profit or loss. So how do we apply this method? Now, number one, when the parent company has invested in an associate or basically a joint venture, and we are preparing this, we are saying we should be able to do that in accordance with the equity method. Now, this method requires one, when preparing this, similar items of revenue and expenses, those of the parent company and those of the associate, or those of the joint venture, should not be consolidated, should not be combined. Should not be what? Should not be combined. So if the parent company has invested in an associate, has invested in a joint venture, you are preparing this, the consolidated statement of profit or loss, we are saying use equity method. And actually, according to the equity method, we are saying don't consolidate similar items of revenue and expenses, those of the parent and those of the joint venture. Like what we are doing in case of an investment in a subsidiary. We said in our previous discussion, once the parent company has invested in a subsidiary and you are preparing this, you should combine similar items of revenue and expenses, those of the parent and those of the subsidiary. But in this case, we are saying we don't do that. So instead, what we include here, as far as the associate or joint venture is concerned, is the group share. The group share, loss associate, or basically joint venture, profit after tax, and other comprehensive incomes. Another comprehensive income. So what we need to do basically is to determine what is the parent company share of the profit after tax and also the other comprehensive incomes which were reported by the associate and also the joint venture, and then we include them within the consolidated statement of profit or loss. But in this case, we are saying never make a mistake of consolidating revenue and expenses, those of the parent, those of the associate, or those of the joint venture. Instead, what we include here is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Then from there, let's look on how this method is applicable when it comes to the preparation of the consolidated statement of financial position. Consolidated statement of financial position. Consolidated statement of financial position. Now, first of all, recall what we said in our previous class. Anytime the parent company has acquired a subsidiary and you're required to prepare this one, consolidated statement of financial position, we said you combine, you add together similar items of assets and liabilities, those of the parent, those of the subsidiary. Is that what we do here? No. So according to the equity method, when preparing the consolidated statement of financial position and the parent company has invested in an associate or basically a joint venture, we don't combine similar items of assets and liabilities, those of the parent and those of the associate or those of the joint venture. So in this case, we can say similar items of assets and liabilities, those of the parent company and those of the associate or those of the joint venture, they are not consolidated. Not consolidated means that they should not be combined. They should not be combined. Like what we are doing in case of an investment in a subsidiary. Here we don't combine. Instead, what do we include here? What do we include in the consolidated statement of financial position as far as the associate or the joint venture is concerned? We include something called the investment in associate, or basically investment in what? In the joint venture. So we have to compute something called the investment in associate, or basically investment in what? Joint venture. And actually we include that, we recognize that as a component of non-current asset in the consolidated statement of financial position. So how do we compute this one? To compute the investment in associate or the investment in joint venture, we start with the cost of investment. So the cost of investment, basically, this is a purchase consideration which was paid by the parent company in acquiring the shares of the associate, or basically acquiring the shares of the joint venture. So how much purchase consideration was paid? And then to this we add the group share of post-acquisition retained earnings, and any other post-acquisition reserve. So when we talk about the post-acquisition retained earnings, post-acquisition reserve, this refers to any reserve of the associate, or basically the joint venture, after it was acquired. So the retained earnings of the associate of the joint venture after it was acquired, or any other reserve of the associate or joint venture after it was acquired, or which must be a post-acquisition. So compute the group share of that. And then to this, you less impairment loss. In most of these particular questions, will be told that the investment in associate or the investment in joint venture had impaired with a certain value. When talk about impairment of investment, this whereby you can invest your money in the company, but that investment loses value. You invested maybe by buying shares having a value of 200,000, but because the company where you invested has been making losses, it has not been able to pay dividends, your investment has reduced in value. The value of the shares you bought has lost some value. So that loss of value of the investment which you made in a company is called an impairment loss. The same case, the parent company may have invested in an associate or joint venture which has been making losses, and therefore you can be told the amount invested in the associate or the joint venture has lost some value. That is called an impairment loss, and basically we should deduct it here. Whatever we get here is basically what is known as the investment in what? In associate, or basically investment in joint venture. And basically this is the only item which is basically recognized. The only item which is recognized in the consolidated statement of financial position as far as the associate or the joint venture is concerned. We don't combine similar items of assets and liabilities, those of the parent and those of the associate, or basically those of the joint venture. Sasa? Yes. So therefore, basically that's what you need to know. But if you can be able to recall what I said, is that most of the questions you will come across in the past papers, you'll be given three companies. You'll be given the parent company. You're told the parent company acquired a subsidiary, and also the parent company acquired an associate, or basically a joint venture. So you have three companies. Now you have to remember what we have discussed here. We have said in case the parent company has already acquired a subsidiary. So whenever we are preparing this consolidated statement of profit or loss, we combine similar items of revenue and expenses those of the parent plus those of the subsidiary, those of the parent plus those of the subsidiary. In this case, I've said we don't include the revenue and expenses of the associate here, So we don't consolidate the revenue and expenses, those of the parent and those of the associate or those of the joint venture. So you only combine for these two companies. So the same case, when preparing this consolidated statement of financial position, you are not supposed to combine to consolidate similar items of assets and liabilities, those of the parent, those of the associate, or those of the joint venture. So you should only combine similar items of assets and liabilities, those of the parent and those of the subsidiary. So we have said what you include here, as far as this associate or joint venture is concerned, is this item. You have to compute this item: investment in associate, investment in joint venture. That's what you recognize here. So here, what you recognize as far as this company is concerned is the parent company share of the associate or joint venture profit after tax and other comprehensive income. Other comprehensive income. So basically, that is it. That's what you need to know as far as this is basically concerned. And I think with that, we can look on a question. I want us to look on a question on this. We look on a question on this, and basically from there, we should be done. So what will be remaining is for us to be able to do more questions on this. I want us to start with basically a simple question here. We can start with a simple question. So let's look on this question for August of 2023. Let's go to the question for August 2023. August 2023. So once you get the question, please confirm. August of 2023. And this is question number 3. That should be question number 3. 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 Yes, I hope you are there. I hope you have that question with you. Are you there? Yes, yes. So what are we told? What are we told here? So we are told that Pika Limited, a public limited entity, intend to expand its operation by acquiring investment in other entities. On 1st of November 2022, Pika Limited secured 75% equity interest in Shiba Limited under the following terms. Number 1, you're told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. Number 2, an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares acquired in Shiba. The fair value of Pika Limited shares was shillings 13 at the date of acquisition. The share issue has not been recorded by Pika Limited. So, and then you're told on the same date, Pika Limited also acquired 30% equity shareholding in Amua, paying shillings 24 million in cash. So then we are told the following draft statement of financial position as at 30th of April 2023 relates to Pika Limited and Shiba Limited. So we're given the statement of financial position for the two companies, Pika and Sheba. We have non-current asset, current asset, equity, non-current liabilities, and current liabilities. We have additional information, number 1 all the way to note number 6. And then what are we required to do here? We are required to prepare on number 1 or part A to calculate the value of goodwill arising on acquisition of Sheba. From part B, determine the value of investment in 𝐼𝐍 Limited as at 30th of April 2023. And part C, we are required to prepare the consolidated statement of financial position of Pika Group as at 30th of April 2023. So before we do that, before we answer our question here, the first thing we need to do, number 1, is basically to come up with a group structure. We said anytime you come up, you come across a question for group account, the first thing you need to do is to come up with a group structure. Then from there, we will go through the additional information. We see, are there some workings which are required? So therefore, let's first of all, we come up with a group structure. So basically working 1 here will be the group structure. The group structure. So which information do we have about this? We are given information about the group structure within paragraph 1. We go back to paragraph 1, you're told Pika Limited, which is a public limited company, intend to expand its operation by entering intend to expand its operation by acquiring investment in other entities. So we are told on 1st of November 2022, Pika Limited secured 75% equity interest in the company which is called what? Sheba. So we are told this company which is called Pika Limited, we are told secured 75% equity interest in the company which is called Sheba Limited, and we are given the date of acquisition, which is 1st November 2022. Remember, this is now the date of acquisition, the DOA. So we are given the terms of acquisition. Those terms, these are the payments which were made. We are going to compute that when answering part A of our question. And then in the last, there is the last paragraph down there where we are told on the same date. I hope you can see that paragraph. We are told on the same date, that is basically this date, we are told Pika Limited also acquired 30%. This company on the same date, 1st November 2022, it also acquired 30% equity shareholding in a company which is called 𝐼𝐍 Limited. 𝐼𝐍 what? Limited are paying shillings 24 million cash. It basically means that this company here, 𝐼𝐍, this will be an associate because you can see the shares acquired lies between 20% to 49%. This is basically an associate. So, but this one, Sheba, this one is automatically a subsidiary company, whereas now Pika Limited will be our parent. So the company which should prepare the group account, we said is always the parent. The group account should be prepared by which company? The parent company. And basically now we have the date of acquisition. Even before you move to computing maybe what is required, we said it is also important for you to be able to identify 2 dates. The 2 dates, the date of acquisition, which is abbreviated as DOA, and the date of consolidation, the DOC. The DOC is the date we require to prepare the group account. So we can only be able to get this date in our requirement. When are we required to prepare the group account? Can we go to part C of that question? In part C of the question, we are required to prepare the consolidated statement of financial position on 30th of April 2023. So the date of acquisition here, you can see it is 1st November 2022. So what we need to determine here is, were these companies acquired in course of the current financial year? If you can be able to remember the question we did in our previous class, the question for 𝐎𝐍𝐋 and 𝐿𝐻, I hope you can be able to remember our subsidiary was acquired 5 years back. So, but in this case, you can see this subsidiary or these 2 companies look like they were acquired during the current year, because even year is ending April, the next year will start 1st May, that is 1st May. So it means that this year started on 1st of May, but 2022. So therefore, you can see this date of acquisition, it falls within the current year. It falls within the current year. So these two companies were acquired in course of the current year. So how many months do we have here? How many months do we have? So we can literally count. We have November, December, January, February, March, April, because that year is ending on April. How many months are those? 1, 2, 3, 4, 5, 6. So it basically means that these two companies, that is Sheba and Pika, they were basically acquired 6 months to the end of the year, 6 months to the end of the year. And we say this is very, very important, specifically when preparing the consolidated statement of profit or loss. If, for example, in our question, though that is not a requirement, if you are preparing, we are required to prepare the consolidated statement of profit or loss. In this case, we said we take the revenue and expenses of this company that is Sheba, basically for 6 months from the date it was acquired. So we take the revenue and expenses of Sheba for just 6 months by basically apportioning its revenue and expenses on time basis, and then we combine with that of the parent. But in our case, we are not required to prepare the consolidated statement of profit or loss. So therefore, it is important to note that these two companies were acquired 6 months to the end of the year. Now, having that, I want us to go straight to the additional information we see. There are some more things we need to do before we even answer our question. So in Roman 1, let's go to Roman 1, we see what you're told. So in Roman 1, you're told at the date of acquisition, the fair value of Sheba Limited, which is basically our subsidiary here, of Sheba Limited net asset, approximated their carrying amount with an exemption of plant, whose fair value exceeded its carrying amount by 10 million. So we said, if you see this, and we say this is something you'll come across in all questions for group account, the fair value adjustment, the fair value exercise, which we said is the devaluation of asset by the subsidiary company on the date of acquisition. So we said because the subsidiary company devalued the asset but never accounted for that, we said in preparation of group account, we make two adjustments, the revaluation adjustment and the depreciation adjustment. So we are told that the plant was valued and basically its fair value exceeded its carrying amount by 10 million. Then in the other paragraph, we are told the plant had a remaining useful life of 10 years at the date of acquisition, and then you're told the plant is being depreciated on straight-line basis. The plant is still carried at its carrying value in Sheba Limited financial statement. In other terms, it means that this company devalued the plant but never accounted for that. That's why it is still carried at carrying amount. In the last point of note 1, we are told no fair value adjustment was necessary on the acquisition of Amua. This company didn't devalue the asset. So in that case, what you're given in note 1 is something called the fair value adjustment or the fair value exercise, specifically by which company? By Sheba Limited. So in this case, we said we have to make two adjustments as far as this is concerned. The first adjustment, and this is exactly the same thing we did in the other question. The first adjustment is called revaluation adjustment. And actually, we said this is an adjustment which is made in relation to the revaluation gain or loss. So if you check on the information which are given in paragraph 1, this company Sheba did fair value adjustment. The net asset, the fair value of the net asset approximated the carrying amount with an exception of an item of plant whose fair value, that is what is important, whose fair value exceeded, the fair value was exceeded or was more than carrying amount. The carrying amount we said is also known as the net book value with 10 million. But if you check our figures up there in our statement of financial position, our figures will be able to see them in thousands of shillings. We must also be consistent. We are going to work with all our figures in thousands of shillings. So this or the fair value of the plant was more than the carrying amount with 10,000 or with 10 million. So this one automatically is a revaluation gain. We said anytime the fair value exceeds the carrying amount is the revaluation gain. And because this revaluation gain was not accounted for by this company, we said this one will be added to the group PPE. This one should be added to the group PPE. And number 2, we said that this 10,000 is a pre-acquisition revaluation reserve. When computing the goodwill on acquisition of Sheba, this will be one of the pre-acquisition reserve we are going to use. So number 2, we make the other adjustment, which is called the depreciation adjustment. Depreciation adjustment. In this case, we said we compute something called the depreciation adder charge. The depreciation adder charge, and that is depreciation adder charge specifically by Shiba Limited. We compute depreciation adder charge by who? By Shiba Limited. I hope you can be able to recall the formula which we use here. We said we take what? The revaluation gain, the exact thing we did in our question, in the other question, the revaluation gain. We divide that with the remaining usufruct, and then in this case we multiply that with the proportion of time. Proportion of time, of which we said proportion of time is basically the time we have from the date of acquisition to the date of consolidation. And I hope you can be able to recall here, that from the date of acquisition to the date of consolidation, I hope you can be able to recall we have how many months? 6 months. So these two companies, or actually Shiba was acquired 6 months to the end of what? To the end of the year. So this formula is what you need to remember always, is what we use in computation of what? The depreciation adder charge. So therefore, to compute this depreciation adder charge, we take the revaluation gain, which is this one, 10,000. We divide that with the remaining usufruct. So what is the remaining usufruct of this plant as per the information we have in note number 1? As per the information we have in note number 1, we are told paragraph 2, the plant had a remaining usufruct of how many years? Of 10 years. Of 10 years. I hope you can be able to see that. Of 10 years. So that is the remaining useful life. And then we multiply that with the proportion of time. The proportion of time here will be 6 all over 12. 6 all over 12. That's basically how we compute the depreciation adder charge. If you take on what you have done in this question, whatever we did in the other question is just the same. It's just the same. And basically I've said that this is an adjustment you will come across in all questions for group account. In all questions for group account, you'll be told the subsidiary company on the date it was acquired, it revalued the asset. You must be able to record the adjustment which you make as far as that is concerned. So this will give us what? This will give us 1,000. A half of that is 500. I hope you're getting 500. So this 500 will be adjusted in which two items? One, this one will be deducted from the group PP in preparing a consolidated balance sheet. And then we also deduct it from the retained earnings of this company. The retained earnings of this what? Company. Now, if in this question also we were preparing the consolidated statement of profit or loss, this one we said we added to the group cost of sales. But automatically this adjustment is not necessary simply because we are not preparing the consolidated statement of a profit or loss. So we will just add that, less that from the group PP, we less it from the retained earnings of who? Of Shiba. Of who? Shiba. So let's move to point number 2. In point number 2, we are told that on 28th April 2023, 28th April of 2023, this is basically some few days to the end of the year. So we are told Shiba Limited, which is this one, sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th of May 2023. I hope you can be able to remember what is that. Automatically, that is now what we refer as the goods in transit. The goods in what? In transit. These are the goods which were sent by this company, but when the year was coming to an end, this company had not received nor recorded those goods. So we refer to them as goods in transit. The goods in transit. The goods in what? The goods in transit. Goods in transit. The GIT. The goods in what? In transit. Now, we said as far as these goods in transit are concerned, we make 3 adjustments. There are 3 adjustments which are made here. That is basically what you need to remember from our discussion. We said we make 3 adjustments. The first adjustment is basically to recognize the goods. To recognize what? The goods. That's the first thing you need to do. To recognize the goods. So these goods which were sent by this company, but when the year was coming to an end, this company had not received and accounted for them. So those particular goods, they had a value of 7 million. Even before we go to the last paragraph, to the next information which is given here, the goods had a value of 7,000,000. So how do we recognize these goods in the books of account of the parent? So if the parent company had received these goods, the parent company or these goods were supposed to be part of the inventory of the parent and part of the payables because the parent company had not paid for them. So therefore, these ones, we will add them to the group inventory. That is first adjustments. And then number 2, we add them to the group payables. So those are the 2 adjustments which will be made to recognize those goods. So if this company had received those goods, they were supposed to be part of the inventory and still part of the payables. Part of the payables. So then the other adjustment which we need to make is the adjustment for unleased profit, because automatically this company made some profit, but automatically the entire profit was not yet realized. This company had not received those goods, so mean that the goods were not yet to be sold to the third parties. We make adjustment for unleased, we compute the unleased profit, and also these goods will give rise to amount of intercompany debt. But before we do that, we can go through the other information which are given in note number 2. Specifically the last sentence of paragraph 1, we are told 𝐻𝐶 Limited, which is basically the company which sold the goods, had marked up these goods at 25% on cost. And then you are told the last paragraph, the agreed trade payables record in the books of PICA, the agreed trade payables recorded in the books of PICA Limited before the above transaction of 6 million. Okay, so before we do that, let's first of all, we compute the unleased profit on these goods, unleased profit on the inventory. So the unleased profit on the inventory. So because we say that these goods were not yet received by this company, so mean that the profit which was made by 𝐻𝐶, this profit was not yet realized. So this unleased profit is by the selling company, which is 𝐻𝐶. So how do we compute this one? We said we take the goods in transit, we multiply that with the gross profit margin. So the goods in transit had a value of 7,000. That is the value of the goods in transit, this one, times the gross profit margin. Are we given the gross profit margin in that question? Are we given the gross profit margin? No. Whatever we are given is the gross profit markup. We are given gross profit markup as 25%. 25% as a fraction is 25% all over 100, which is basically a quarter. So if we have that as our markup, how do we compute the gross profit margin? We say this one would be equal to 1 all over 4, and then to this we add the numerator. So this one would be 1 all over 5. That is our margin. So our margin therefore here will be 1 all over 5. So give me the final figure here. The final figure here, which is 7,000 divided by 5. So that will give us an unleased profit of 1,400. So this unleased profit 1 will basically be deducted from the group inventory. And number 2, we also deduct this from the retained earnings of 𝐻𝐶. The retained earnings of 𝐻𝐶. So the other adjustments which we need to make as far as these goods are concerned is an adjustment for amount of intercompany debt. Amount of intercompany debt. Remember, this company sold some goods, sent them to the parent, but basically, because this company had not received those goods, automatically it had not paid for them. So that gives rise to amount of intercompany debt. Amount of intercompany debt. So the amount of intercompany debt automatically would be equal to 7 million. But now there is also another information which are given in note number 2, the last sentence. Can we go to note number 2, the last paragraph? We are told the agreed trade payables recorded in the books of PICA before the above transaction was 6 million. What does that mean? It basically means that before this transaction here, before this transaction of the goods in transit, there was another amount of intercompany debt of how much? Of 6 million. So by the end of the day, the amount of intercompany debt between Sheba and PICA will be equal to the 6 million plus this other amount of 7 million. So the total amount of intercompany debt by the end of the day will be what? Will be 6 million plus now this one, 7 million. This is the total amount of intercompany debt. So this total amount of intercompany debt, this one, 13 million. This one, recall the adjustment. This one will be deducted from the group receivables and also from the group what? Payables. And remember, this amount of intercompany debt is the same. So it will be deducted from the group receivables and also deducted from the group what? From the group payables. The amount of 13 million. The amount of 13 million. So having said, we need to move to the other point. So therefore, if you come across that adjustment or that item, the goods in transit, you have to recall those 3 adjustments. Recognize the goods, compute the amount of the nearest profit, also they give rise to amount of intercompany debt. So number 3, we are told, a PICA limited policy is to measure the non-controlling interest at fair value on the date of acquisition. We say this information is to help you compute the goodwill. NCI is to be measured at fair value. When computing the goodwill on acquisition of the subsidiary, we use the full goodwill method. We are told for this purpose, the directors of PICA Limited consider Sheba Limited shares of shillings. Sheba Limited share price of shillings 12 per share to be appropriate. In this case, we are not specifically given the NCI at fair value, but I'll be able to show you how we compute that specifically when answering Roman part A of the question. So, but when computing the goodwill on acquisition of Sheba, we are going to use the full goodwill method. Then number 4, we are told impairment test performed on 30th of April 2024 at the end of the current year revealed that the goodwill on acquisition of Sheba Limited had not impaired. The goodwill on acquisition of Sheba had not impaired. We don't have any impairment loss. And then you're told, but due to the declining sales of Amua, which is the associate, the value of investment in Amua had been impaired to an extent of 2 million. So this is an impairment loss in relation to the investment made in Amua. So we are going to use that in answering part B. And then number 5, we are told Amua Limited reported profit after tax of 4 million during the current year. Also, that one will be used in answering part B. And then you are told number 6, assume all the profit and losses of the 3 companies accrued evenly throughout the year. So I think no workings which are required there. So what we need to do, we can go straight to answering part A of the question, basically whereby you are required to compute the goodwill on acquisition. The goodwill on acquisition of what? The goodwill on acquisition of Sheba Limited. Remember, in this case, I've said, as per the information which are given in note number 3, we are going to use the full goodwill method. We will use the full goodwill method because we are told the policy of the group is to measure NCI at fair value. We said if you come across that information, then compute the goodwill using the full goodwill method. So in this case, we need to have 2 columns. 2 columns here. So what do we start with here? We always start with the purchase consideration. The purchase consideration which was paid by the parent, company. And then to this, we will add the purchase consideration paid by the NCI. So the purchase consideration paid by the parent company, this information, we have it below paragraph 1. So let's go back to paragraph 1 of our question here. Paragraph 1. In paragraph 1, we are told PICA Limited, which is our parent, a public limited entity intends to expand its operation by acquiring investment in other entities. In the last sentence, we are told, on 1st April 2022, Pika Limited acquired or secured 75% equity interest in Shiba under the following terms. We are given the terms of acquisition. We are told an immediate cash payment at a fair value of shillings 13 per share on 1st November 2022. So in this case, we are told when the parent company acquired 75% of Shiba, there was a cash consideration. The cash what? Consideration, that immediate cash payment. Immediate cash payment, if you can be able to recall, we refer to that as what? As cash payment. And in this case, we are told the amount which was paid here is 13 shillings per share. 13 shillings per share. Now, you may decide to compute this. So basically, to compute that, we should take 13 shillings. 13 shillings, you multiply that with the shares acquired in Shiba. The shares acquired. The shares which were acquired. But there is no need of computing this because this value is given in the statement of financial position of Pika. Can we go to the statement of financial position of Pika? Specifically where we have the non-current assets. In the statement of financial position of Pika, under the non-current assets, we have PPE, property, plant, and equipment. And then from there, we have investment in Shiba. Investment in Shiba, you can see we are given 6 million shares at shilling 16, at shilling 13. So meaning that the shares which Pika Limited acquired in Shiba was 6 million. So 6 million times the amount which was to be paid per share, which will give us what? Which will give us 48 million. 48 what? Million. So, and why are we told that the shares acquired were 6 million? So we can first of all determine how many shares are issued by this company. The shares issued by Shiba, you get that from the balance sheet of Shiba at the equity. At the equity, the share capital of this is 80,000. So for us to be able to know the shares issued by Shiba, we will divide that with the par value. And I hope you can see the par value where we have the word ordinary shares in the balance sheet. The ordinary shares of this company, they have a par value of 10. So the shares issued by this company are 8,000. So the shares Pika Limited acquired in Shiba was 75%. So if you get 75% of this, that basically will give you 6,000. Alan, what are you referring to, 78 or 48? Okay, so the price is okay. This one should be 78, not 48. Yes, so that one is okay. It should be 78. Yes. So therefore, the cash consideration here is 78. 78. So 13 shillings times the shares acquired. Then I want us to go back to the information we have below paragraph 1, because other than this cash consideration, in point number 2, we are told there was an issue of 3 ordinary shares of shillings 10 per value in Pika Limited for every 5 shares which were acquired in Shiba. If you can be able to recall, we refer to that as the share exchange consideration. The share exchange consideration. So for the share exchange consideration, you need first of all to remember the formula. How do we compute the share exchange consideration? The share exchange consideration. In this case, we say compute the number of shares which were issued by the parent. Issued by who? The parent company. So this one we said the examiner will not give you this one, and then multiply these shares with their fair value or market price on the date of acquisition. So this is something we are already given. In that point. In that point, we are told the last sentence of that point 2, we are told the share issue. Okay, not that point, but point number 2. There is one somewhere we are told the fair value of Pika Limited shares was shillings 13 per share on the date of acquisition. So the shares of the parent company on the date of acquisition, they had a market price or a fair value of shillings 13. That one is already given. So what we need to do is to determine this. how many shares were issued by the parent company to pay the purchase consideration? We are going to use that information we have in point 2, where we are told an issue of 3 ordinary shares of shillings 10 in Pika. So Pika here was to issue, Pika Limited was to issue 3 shares for every 5 shares which were acquired, for every 5 shares which were acquired. So in our case, do we know how many shares were acquired by Pika in Shiba? Do you know how many shares Shiba Limited acquired in Pika? Sorry, how many shares Pika Limited acquired in Shiba? Do we know how many shares were acquired by our parent company, the subsidiary? Do we know how many shares were acquired by the parent company in the subsidiary? Do we know how many shares were acquired? Do we know how many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? How many shares did the parent company acquire in the subsidiary? How many shares were acquired? We have already dealt with that somewhere here. Just now. Yes, we have said the shares which were acquired were 6 million. We have computed that here. We have said that this one was also computed based on 6,000 shares which were acquired. The shares which were acquired were 6,000. So what we just need to do is to cross multiply, then we divide. So therefore, the shares which were issued here will be, because we need to cross multiply, then we divide 3 times 6,000 divided by 5. So this will give us 12, and basically that will give us what? That is 600. That is 600 shares. So these are the shares which were issued by the parent company. The parent company issued these shares. It issued, that is 600 shares, and then we need to multiply those shares with their fair value, which is shillings 13. So therefore, let's compute the share exchange consideration. That is 6 times 13. So I'm getting a figure of verse 40. 46,800. Are you getting that figure? 46,800. 46,800, yes. So now, this is the purchase consideration paid by the parent. Then to this we say, when using the full gooding method, we add something called the NCI at fair value. In other terms, if you can be able to recall, we said NCI at fair value. This refers to the purchase consideration paid by NCI. So when the minority shareholders acquired their shares, how much amount did they pay? Now, if you go back to the information we have in note number 3, we are not given this NCI at fair value. If you can remember the other question we did for Kuja 20, this value was given, the NCI at fair value. But if that NCI at fair value is not given, to compute that is quite simple, because we are saying when minority shareholders acquired their shares here, how much amount did they pay? So automatically you need to determine how many shares were acquired by the minority shareholders here. We know the parent company acquired 75% of the shares. The remaining 25% of the shares are the ones which were acquired by who? The minority shareholders. The minority shareholders acquired the remaining 25% of the shares. So therefore, we need to compute how many shares were acquired by the minority shareholders. 25% of the shares issued by this company. Hope you can remember, we have said that the shares issued by Shiba are 8,000. It's share capital divided by the par value. The shares issued by Shiba are 8,000. So these are the shares acquired by minority shareholders. So for us to be able to know the amount they paid for those shares, we have to multiply that with the market price of the share on the date the shares were acquired. So automatically the shares were acquired on this date. The date of this date of acquisition. Now, if you go back to point number 3, the last sentence, we are told for this purpose, the directors of Pika Limited considered Shiba Limited share price of shillings 12 per share to be appropriate. So it basically means that when the parent company acquired 75% of the share, when the minority shareholders acquired 25% of the shares of this, each share had a market price of shillings what? Each share had a market price of shillings 12. So meaning that the amount of purchase consideration paid by minority shareholders was what? Was the shares they acquired, 25% of this times the market price per share. They paid shillings 12. They paid shillings what? 12. So therefore, in case you come across a question and you're not given the NCI fair value, what you do, compute the shares acquired by minority shareholders by NCI, multiply those shares with their market price on the date of acquisition. That will give you what? The purchase consideration, which was paid. So this will give us 0.25 times 8,000, which basically 2,000 times 12, which will give us what? 24,000. Yes. So in this case, we need to add all this, which is the purchase consideration paid by the parent and who? NCI. So we have 78 plus 46.8 plus 24. And this will give us 148,800. So that is the purchase consideration paid by both the parent and also who? NCI. And then to this, we proceed with less the fair value of net assets acquired. Fair value of net assets acquired. Fair value of net assets acquired. This is basically something we said the examiner will not have given you. So, but you have to compute this. We said in this case we need to determine at the date this company was acquired, what was the fair value of its net asset? And actually we said we compute that by adding its ordinary share capital plus the pre-acquisition reserves. So therefore what we need to do here is basically to take the ordinary share capital of this company, that is of Shiba. Where do we get that? We get that at the equity section in the balance sheet of Shiba. So the ordinary share capital of this company is what? From its statement of financial position, it is 80,000. So below that, we don't have anything else, but basically what we have is the retained profit. So retained profit, or basically the retained earnings, this one we need to compute the retained earnings of the date of it was acquired. Now, if you check on this question, there is nowhere we are told we are given the retained earnings of this company on the date it was acquired. So generally, this is something you need to know moving forward. Anytime a subsidiary company was acquired during the current year, there is no single time the examiner will give you its retained earnings on the date of acquisition. But if you can remember the other question which we did for Kuja Trade, which was acquired, a subsidiary was acquired 5 years back, we were given its retained earnings on the date of acquisition. So, but a subsidiary acquired during the current year, the examiner will not give you its retained earnings. In very rare cases, the examiner will give you that. So you have to compute. Basically, what we know, I hope you can be able to remember that this subsidiary was acquired 6 months to the end of the year. That's what we said. It was acquired 6 months to the end of the year and automatically 6 months from the start. So what we do for us to be able to compute, because what you're interested with is the retained earnings of Shiba on this date. It was acquired 6 months from the start of the year, 6 months to the end of the year. So if you go back to the information we have in the balance sheet, when you go to the balance sheet of Shiba, specifically at the equity, you can see we are given the retained earnings of Shiba at the start of the year. That is on 1st May 2022. 1st May 2022 is at the start. We are given the retained earnings of that company at the start of the year. The retained earnings of Shiba. Remember, you're interested with Shiba at the start of the year here, which was 12,800. That is the retained earnings of Shiba at the start. And then we also given the profit for this year, the retained profit for this year for Shiba, which is 10,800. So the reason why you're given that information is for you to be able to compute the retained earnings of Shiba on this date here. This date. How do we compute the retained earnings on the date of acquisition? Very, very simple. We take the retained earnings at the start of the year, this one, which is 12,800. And then to this, we add the profit, which was the retained profit for this period, for these 6 months, because we're interested with the retained earnings of Sheba on that date. So how do we get the retained earnings for the first 6 months? So we will take the retained profit for the whole year, which we also given as 10,800, and then we apportion this on time basis. We multiply that with 6 over 12, so that we know the retained earnings for the first 6 months. So once we take this as the retained profit for 6 months, we will be able to get the retained earnings of Sheba on the date it was acquired, that date there. So this will give us 12,800 plus basically half of this, which is 5,400, and this will give us what? This will give us 18,200. 18,200. Are you getting 18,200? 18,200. Yes, that will give us 18,200, and basically that is the retained earnings of Sheba on the date it was acquired. So therefore, anytime a subsidiary was acquired during the current year, the examiner will not give you its retained earnings on the date of acquisition. You must compute that. So that is basically the only reserve which we have within the balance sheet of Sheba. Then from there is something we said you must always remember to check whether the subsidiary company revalued assets on the date of acquisition. If yes, was there a revaluation gain? And I hope you can be able to remember on the date Sheba Limited was acquired, it revalued an item of asset, and there was a revaluation gain of 10,000, this one. So that one, we recognize it here. We recognize that there as a pre-acquisition what? Reserve. And basically in our case, we don't have anything else. So what we need to do is basically to get this total. To get this total, so let's add all those figures. We have 18,200 plus 10 plus 80. This will give us 108, 200, 108, 200, 108, 200. And in this case, remember, we're interested with the goodwill of the parent and the goodwill of the NCI. So what we do here, we take the net asset acquired by the parent and the NCI. The net asset acquired by the parent and the NCI should be 100% of this. So 100% of this is 108, 200, which basically will be less from the figure we have up here. We take 100% of that. So we less that from 148, 800. And this will give us a figure of 46 what? 600. 4600. So this is what? This is the goodwill on acquisition. The goodwill on acquisition. And remember, the information which are given in note number 4, we are told that this goodwill is not impaired. The goodwill has not lost any what? Any value. So that is basically the amount we are going to take to, we are going to recognize in the statement of financial position as a non-current asset. So this is what was required in part A of that question. And basically by doing this, the marks allocated here basically were 4 marks. So let's move to part B of that question. Part B. So in part B, what are we required to do? We are required to compute the value of investment in 𝐉𝐻𝐶 Limited. So this is part B, value of investment in 𝐉𝐻𝐶 Limited. In 𝐉𝐻𝐶 Limited. In other terms, what we are required to compute here is something called the investment in associate. Remember, 𝐉𝐻𝐶 Limited is an associate. We are required to compute the investment in associate. So, and what you just need to recall is the format which I've just given you. How do we compute the investment in an associate? I've said we take the cost of investment, or the purchase consideration, and then to this we have said we add the group share of post-acquisition retained earnings, retained earnings, and any other reserve. And I think in this case, this associate do not have any other reserve other than the retained earnings. And then to this, we less what? Any impairment loss. Any impairment what? Loss. This one is quite simple because everything is provided here. I think we can start with the impairment loss, this one, which is given in note number 4. In note number 4. In note number 4, we are told that impairment test performed at the end of the year revealed that the goodwill on acquisition of 𝐲𝐶 was not impaired. This one had not impaired, but due to declining sales of Amua, the value of investment in Amua was impaired by 2 million. So we have an impairment loss here of 2 million, which basically we less here. So what about this one? So we know that this associate was acquired 6 months to the end of the year. So if you go to note number 5, we are told Amua Limited reported a profit after tax, which is the same with the retained profit of 4 million for the year. During the current year, this company reported a profit of 4 million. 4 million. And taking into account it was acquired 6 months to the end of the year, we want to know how much profit will the parent company be entitled to share. We will take the profit for the whole year, 4 million. But in our case, we're interested with the profit from the date Amua was acquired. Amua was acquired 6 months to the end of the year. So we compute the profit after Amua was acquired, and that is what we refer as the post-acquisition retained earnings, which will be 6 months to the end of the year. We multiply that with 6 over 12. We get the profit for the last 6 months, and then we get the parent company share of that. The parent company share of that will be equal to 30%. Will be equal to 30%. So let's work out that, which is basically quite simple. Half, which is 2,000. We multiply that times 0.3. And that will give us what? That will give us 600. That will give us 600. Then this one is given. This one is given. So we go to the balance sheet of the parent, the balance sheet of parent at the assets. How much amount did the parent company invested in Amua? So that is given in the balance sheet of Pika at the non-current assets. The amount invested in Amua is 24,000. 24,000. So you can see this one was quite simple because almost everything was given. So we compute now the investment in associate. 24 million plus 600 minus 2,000. So that will give us 22,600. 22,600. I hope that is what you're getting. I hope that is what you're getting, yes. And basically by doing that, equally the marks allocated there are 4. So let's move to the last part of the question, whereby we are required to prepare the consolidated statement of financial position, basically for the year, which ended 30th of April 2023. 30th of April 2023. 30th of April 2023. 30th of April 2023. So Aaron, you're asking about what? How did you get 20,000 revaluation gain on part? Where do you have revaluation gain, Aaron? Do you have a revaluation gain somewhere of 20,000? I can't see that. I can't see any revaluation gain of 20,000. I can't see a revaluation gain of 20,000. So maybe retype your question again. Retype your question again of 10,000. This is what we dealt with here, Aaron. Check what we did in working one. Working one. And basically, can you try to see what we did in the other question? If you can be able to recall what we did in the other question, we are doing the same thing here. We are doing the same thing. So try to understand those concepts which are in all questions, especially this one. This one, you must understand this. This is in all question for group account, fair value adjustment. So let's prepare this one. And basically, how do we prepare this? I want us to do this in the next 20 minutes. How do we prepare this one? We prepare this basically by combining similar items of assets and liabilities, those of the parent, those of the subsidiary. And that's why in this case, for example, you can see even the examiner has not given you the asset and liabilities of who? Of associate, because we don't consolidate an associate. What we include here as far as the associate is concerned is what we have computed here. Yes, so we only add assets and liabilities of the parent, those of the subsidiary. The other thing which is also important for you to note is that even if this subsidiary was acquired 6 months to the end of the year, we don't do what? We don't apportion asset and liabilities on time basis. So apportionment only applies to revenue and expenses. So we have to take the full amount of asset and liabilities of the subsidiary, even if it was acquired 6 months to the end of what? Of the year. So let's do that. So here, we will start with the non-current assets. So I will take the PPE and basically take the PPE of the parent, 135, plus the PPE of the subsidiary, 100, 400. And then to this, we need to check, do we have any adjustment affecting the PPE? Yes, this working one. Working one, this revaluation gain, we said we added to the PPE. And then number 2, we have this depreciation under charge of 500, which we said we less from the PPE. So 2 adjustments here. We add 10,000, the revaluation gain, and then we less what? We less 500. No any other adjustments. No any other adjustment. We get the final figure. We have 135 plus 100, 400 plus 10 minus 500. And I'm getting 244, 900. 244, 900. So below that, please confirm whether you're getting the same figure. So below that, we have investment in Shiba, investment in Amua. Do we include those items here? The purchase consideration paid in acquiring shares of Shiba and Amua? No. Instead, the investment in Shiba has been used in the computation of this goodwill. So what we include here in relation to Shiba is the goodwill on acquisition of Shiba Limited. How much is that? 4,600. That is basically what we include here. In relation to Amua, we include what we have computed here. The investment in Amua. The investment in Amua, what we have computed here, 22,600. That's basically what we include here. And I think in our case, we are done with the non-current assets. So we need to proceed and basically record the current assets. So for the current asset, I will start with the inventory. So for the inventory, I will take for the 2 companies, I combine them, and then I make the necessary consolidation adjustment. 28,400 plus 12,100. And we said we have a number of adjustments affecting that. One, we have this goods in transit. Goods in transit. We said this 7,000 will be added to the group inventory. And then we have this unreleased profit over 14, which we said we also left from the group inventory. So 2 adjustments will be made here. So we add 7,000, the goods in transit, this one. And then we do what? We left this unreleased profit of 14. We less that unreleased profit, we get the final figure, So we have 28,400 plus 12,100 plus 7 minus 14. So which will give us 46,100. Okay. So below that we have we have the trade receivables. We have the trade receivables. The trade receivables, I'll do the same. I'll take the trade receivables of the 2 companies, I combine them, 27,500 plus 19,900. And then I check, do we have any adjustment here? Yes. We have this adjustment for amount of intercompany debt. 13, which will be deducted from this group receivables. I only have this adjustment here. That no any other adjustments. So we get the final figure, 27,500 plus 19,900 minus 13. So which will give us 34,400. So then finally we have the cash and cash equivalents. So we add for those two, for the two companies, that is basically 10,600 plus 68 plus 68. Do we have any adjustment affecting this? No, because we don't have any cash in transit. We just need to get the total. We just need to get the total. So that will give us 17,400. 17,400. And then what do we need to do? We need to get the total assets. So the total assets, we add all this. We have 17,400 plus 34,400 plus 46,100 plus 22,600 plus 46 plus 244.9. So in this case, I'm getting 406. I'm getting 406, 406, 406, 406,000, 46,000, 46,000. I don't know whether you're getting the same. So I can do away with this to create space here. Yes, someone to confirm whether you're getting the same. Yes, that is confirmed by Juliet. Okay, so then from there we proceed and record equity. So that is share capital and reserves. So at the equity, we will start with the ordinary share capital. Ordinary share capital. In this case, we said for the ordinary share capital, we record that of the parent company only. The ordinary share capital of the parent, in this case, will be 160,000. But in this question, the ordinary share capital of the parent will be having an adjustment. We said whenever the parent company has paid some purchase consideration by issuing shares, those shares which were issued by the parent company, they were not accounted for. And basically, we said the shares issued will affect the ordinary share capital and the share premium. So, and how many shares were issued by the parent company, the payment of purchase consideration? We computed those shares. In our computation of the purchase consideration, did we say the parent company issued, were they that 600? Because the parent company was to issue 3 shares for every 5 shares acquired. The shares acquired was 6,000. I think we multiplied this. So this was the 3 times 6,000 divided by 5. And I think this was coming to 36. Yes. The shares issued by the parent were 36. Now, what do we add here to the share capital? The amount we add to the share capital is an amount equal to the par value. So the par value of these shares, would be 36 times the par value per share, which is 10, So that will increase this. So this will be 36,000 times this, which will give us 196. And when the parent company issued these shares, what was the market price per share? In a market price to compute purchase consideration, was it? It was 13. Was it 13 shillings? 13. So the amount which is above 10, and basically that is 3 shillings. That is a share premium. So belonging to the parent. So in relation to these shares which were issued by the parent, tutakuwa na share premium ya 36 times what? Times 3 shillings. Times 3 shillings. Times 3 shillings. That will give us what? That will give us what? That will give us then 800. That will give us then what? 10,800 is the share premium of the parent. Yes. So then from there, there is something we said which must be computed here, which we said this is one of the items which is quite demanding, and that is the retained earnings. And I think moving forward, there are those items. In fact, because we said even in an exam setup, these are items you don't need to compute. Like this one, the retained earnings, because we said by doing this, it's not a must, you have to get everything correct. Sasa? Yes. So maybe first of all, you can skip this. If you're going to have some time, we will compute. But this is an item I'll not advise you, even in an exam, never bother yourself computing this. The other item we also need to compute and we include here is basically something called the non-controlling interest. Also, we will compute that if time will allow. But let's first of all, we proceed and record the liabilities. We will be able to compute that. So these are two items which are quite demanding. So the non-current liabilities, I will start with there are actually two. We have 10% bank loan, 10% bank loan. No adjustment for this. We just add that of the parent and that of the subsidiary. This will give us 35,000. No adjustments there. Below that, we have deferred tax. We said anytime you come across a component for tax, also this is a pre-mark. No adjustment. We just add 37 plus what? Plus 31, which will give us 68. No adjustments here. Then we go to the current liabilities. For the current liabilities, we will start with the trade payables. Trade payables, we add that of the parent, 28,800, plus that of the subsidiary, which is 21,200. And then now to this, we have, I think, two adjustments affecting the payables. One, we have these goods in transit. This amount of 7,000, we said we added to the payables. So to the payables, we add 7,000. And then I hope you can also be able to recall we have this amount of intercompany debt, 13. So to be deducted from payables. So we also less 13,000. So those are the only items, the two items to be adjusted to the payables, So let's get the final figure here, which is 28,800 plus 21,200 plus 7,000 minus 13. So I'm getting 44,000. 44,000 like that. 44,000 like that. And then finally, I have current tax. Current tax, we said, being a component of tax, this is also another free mark. So you have 19 plus what? Plus 13. Plus 13. This is also a free mark. And basically, this will give us what? This will give us 32. This will give us what? 32. This will give us 32. Then we will get the total equity and what? The total equity and liabilities. The total equity and what? And liabilities. The total equity and liabilities. Do we need to compute these two items or we can just leave them? Do we need to compute them or we can just leave them? Because like this question, by doing that, we'll be able to get all the marks, even without necessarily coming back to compute these two items. I hope you can be able to recall the other question which we did, the computation of these two items. We said we were able to see that it is basically quite demanding. But basically, once we're able to do this, you'll be in a position to score all the marks. You'll be in a position to score all what? The marks. You can see the marks allocated there are 12. In most of the cases, this is how the marks are allocated. For every 6 correct entries, you are given 2 marks. You're given 2 what? 2 marks. For every correct entry here, you get how many marks? You get 2. You get 2. It basically means that it's not a must. You have to get everything correct. Everything good? Correct. Sasa? Yes. So easy 2 items. I think we can just leave them. No need of computing them. You'll be able to see that even during our revision, kuna zile vitu tutakuwa tuna compute. Tunaambia kwa mtihani na this one, you don't need to compute that. It will basically consume a lot of your time, and you don't have to compute some of those items for you to be able to get all what? All the marks. All what? The marks. Now, I want us to stop at that point for today. I want you to have a short break before you start the other class. We stopped at that point for today. There are so many questions from the past papers. I want us to do another one question in our next class. Then after doing that, we will wind up with this topic, but we will be able to come back to this topic during our revision because there are like two topic, not big topic. We have a topic on borrowing cost. Will just take us one class, and a topic on conversion of partnership into a limited liability company. I think majorly those are like the computation topics which are remaining. Before now, we start our revision and we look on some theory topics which are remaining. So right now, I say we are almost 90% done with the syllabus, 90% done. I'm hoping that actually by next week, because on Tuesday, we will be able to do one question on this. We will be able to see whether we can be able to do two. If we can be able to do two, that would be very good for us. We see whether we can be able to do two questions. We wind up with this. And then from there, our next class on Thursday, God willing, we should be able to do borrowing costs. And then we start on, I think, let's start with the conversion of partnership on Thursday, which we should be able to finish on Saturday. And it basically means that by the other week, we will be having, I think, one computation topic, which will be remaining. Though there are other theory topics which will be remaining, which I think we will be able to create time and basically go through them. So therefore, I'm saying right now, I think we are over 90% done with the syllabus. Remember what we agreed by 21st, we should be able to embark on revision. We should be able to embark on what? On revision. Yes. So maybe you can check on the question which was there sitting or any other question. We will pick a question having 3 companies, parent, associate, and also a joint venture, or basically that is parent, associate, or joint venture and a subsidiary, and basically a question requiring the preparation of consolidated statement of profit or loss and the consolidated statement of financial position, so that we finish on this work on this topic. So let's stop at that point for today. We continue from there in our next class. So have a nice weekend. See you next week.